So the Federal Reserve cut interest rates recently for the first time in more than a decade as it tried to keep America's record-long economic expansion going by insulating the economy from mounting global risks. And my guest is Zach Abraham. He is Chief Investment Officer at Bulwark Capital Management in Seattle. Zach, always a pleasure. So the Fed normally doesn't cut interest rates unless we are in a recession. So are we in a recession, technically?
I think that's a great question. One thing that we're talking to our clients about all the time, both in person and also on our radio show, is context. You know, the importance of putting things into context. If we look at the last 10 years in the U.S. economy, they were the worst and slowest growing. It was the slowest growth decade in history, including the Great Depression. And yet, when we look across asset classes across the board, they're all at record highs. Real estate, bonds, stocks, everything. Here in the U.S., it's not the same story abroad. Now, there are some reasons for that, and as always the case, when markets go parabolic like this, there's always the majority of people are going to be out there, justifying it, saying it's justified for this reason, that reason, all that kind of stuff. At the end of the day, the reason why asset price appreciation has worked so differently during this last decade as opposed to the other slowest decade in history, the Great Depression, is due to one reason and one reason only, and that is central bank interference and printing of nearly $4 trillion and shoving it into the financial system. So you have a market that is trained to respond to interest rate cuts or stimulus from central banks of any kind. I think this round it is entirely possible that this next round of rate cuts, because I don't think that they're done, it is entirely possible that it propels this market to new record highs. I wouldn't be surprised to see the market go 25, 30, 35, maybe even 40% from here. But I think that if investors get caught looking at that, they're going to miss some really, really important things, which is this is the most ridiculously priced equity market in history. I don't care what anybody else says. You're going to find a bunch of market apologists and a bunch of stock market apologists that come out and try to rationalize it and try to make up reasons. And they're going to talk to you about things like forward PE ratios, which are completely worthless. The valuation metrics that these guys are citing to argue that the stock market is not overvalued is forward PE, which means it's a price to earnings ratio, but it's looking forward over the next 12 months. So it's based on analyst projections. So it's not even real. And if we put this in language that we can all understand, what they're asking you to do as an investor is to pay a price for their company based on what they're telling you they're going to do over the next 12 months. So we have a joke in our office that forward PE is what you use when you're trying to sell a stock, and trailing 12 price to earnings ratio is what you use when you want to buy a stock, right? So it's that difference of looking at it through jaundiced eyes. And interestingly enough, that's the only valuation metric they cite. If you look at price to sales, record high. If you look at enterprise value to EBITDA, which is enterprise value takes the market cap of a company plus its debt. Now, the reason we think that's important is because debt-fueled buybacks have been one of the biggest consumers of stock over the last 10 years. So if we're going to look at valuations of stock, it's only natural to us that we would need to include debt into that metric. And then EBITDA is basically cash flow. It's before, they've got to pay, EBITDA, EBITDA. It's earnings before interest, taxes, depreciation, and amortization. So it's free cash flow. So we think that's important because now we're saying, okay, what is the stock worth plus the debt, and then comparing that to the cash flow of the company. When we look at that metric, in 2009, at the height of the tech bubble, and at 2007, height of the real estate bubble, that metric reached like a 20 or a 21, okay? Today it's at 43. So we're double the levels of the last two bubbles. If we look at market cap to gross domestic product, Warren Buffett's valuation metric, that is at a record high. Price to sales is at a record high. Corporate debt is 2 times larger than it was in 2007. So now the crazy thing about this all, Scott, is that it doesn't mean that stocks are done going up. But what it means is that if they go up further, if they go up substantively further, I think it's just going to serve as a mechanism to suck more people in, and the roof's going to cave in on them. When reality sets in, because it always does.
Well, Zach, finally, does this indicate a change in Fed policy? Because this appears to be more of a proactive move than what the Fed typically does, is to be reactive.
Yeah, it's kind of a mix, and again, I think it points to this dichotomy that you have in what's going on in the real economy and what's going on in the stock market. The Fed's not. The Fed has made some incredibly horrible. The Fed is not who you'd want managing your money, because they'd have an absolute atrocious track record. But they have always been reactive, and I think the reason they're being more proactive this time is because they see the record levels of corporate debt, because they see the slowing growth around the economy, because they see record government debts. And they realize, remember, they want to stave off a currency or a recession horribly, because if you've got a government like ours that's already running at $1.4 trillion deficits and 110% debt to GDP, you go into a recession, all of a sudden tax receipts drop, but government payments don't. So if you think the deficit looks bad right now, wait till you see it in the next recession. So I think that they're doing that, and ironically, investors are getting all excited about the cuts. The fact that they're being proactive, like you said, that's a break from tradition, it really is. But the fact that they're being proactive, I think points to bigger underlying issues. And yet I'll keep throwing that caveat in there. That does not mean that we're saying the market's going to collapse imminently. I don't think the next 5 to 7 years are going to be good in the stock market. I think that they have the potential to be downright scary. But, we still might be 20 to 30% away from the highs. The thing that we keep reiterating to our clients is, you are not a hedge fund. Your job is not to beat the S&P 500. Your job is to get your retirement assets to fund your retirement with as little risk as possible. And so just sticking to that disciplined approach and knowing that if we do that, at some point over the next, probably 1 to 3 years, we're going to have an opportunity to take more risk and make more money. But now is certainly not the time to just kind of be flying blind.
That's Zach Abraham. He is Chief Investment Officer at Bulwark Capital Management in Seattle. This is Retirement News Online. Thanks for watching.